I'm going to say 4,000. I do think we'll pull back close to 3,000, but if I have to say by year end, I think gold is closer to 4,000. I think instability. I think, again, eventually the economy will continue to weaken slowly, but it'll weaken. And I think that pushes more people into gold. This trend line right here. So we were hovering on silver right in this 34 and a half level. High pivot, hit it here, pulled back. Hit it here. Look at how we consolidated and then broke out. And then you got this beautiful bull flag, sideways consolidation above the breakout line. That tells you it's going to go higher. It zoomed higher, but look at where it stopped on a dime, a long-term trend line.
Silver has officially broken out in a big way, kicking off what many see as the start of its bull market. Precious metals have been among the strongest performers in the commodities sector this year, with gold hitting record highs and gaining over 25% on the back of central bank buying and steady inflows into exchange-traded funds. The ongoing US-led trade war has also fueled demand for safe haven assets. Yet, silver has outpaced gold in terms of year-to-date gains, benefiting from its dual role as both an industrial input and a financial asset. Gareth Soloway, chief market strategist at Verified Investing, says silver's recent move followed a classic technical setup. It broke through a significant resistance level, formed a bullish flag pattern, and then surged higher. Now, it's encountering a long-term trend line that has previously acted as resistance. The current pullback is expected and normal, as the metal hit its short-term target. Soloway remains bullish and sees the current consolidation as a healthy pause before the next leg higher. Citigroup Incorporated projects that silver will extend its rally beyond $40 an ounce in the coming months, driven by tightening physical supplies and increased investment demand. While gold has made substantial gains over the past year, silver has repeatedly been capped by two major resistance zones, $32 to $33 and $34 to $35, creating a prolonged period of consolidation. With those levels now behind it, silver appears to have clear upward momentum. Soloway also expects gold to reach around $4,000 by year-end, though he believes a pullback to $3,000 could come first. He views such a dip as a buying opportunity, citing relentless government spending and monetary expansion as reasons to remain long-term bullish. While ETF inflows have slowed and net long positions in futures have declined, gold continues to enjoy support from ongoing central bank purchases. These underlying drivers suggest that any weakness may be temporary and the broader uptrend remains intact. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
And I say, essentially, Ethereum is the silver, gold is the Bitcoin, right? Bitcoin is gold. The same sort of thing. You have the catch-up trade. So gold has zoomed up so much in the near term that essentially, eventually, investors say, yeah, I don't really want to pay 34, 3,500 on gold. But look at silver. It's not even at its multi-year high yet. Now it's had a big move up. And I want to show this chart here because this is pretty cool stuff when we go to this chart on silver, because silver, again, had a beautiful breakout. So let me walk you guys through this chart. Notice this trend line right here. So we were hovering on silver right in this 34 and a half level. High pivot, hit it here, pulled back. Hit it here. Look at how we consolidated and then broke out. And then you got this beautiful bull flag, sideways consolidation above the breakout line. That tells you it's going to go higher. It zoomed higher, but look at where it stopped on a dime, a long-term trend line. This is why we just talked about the NASDAQ, that upper parallel line. Same thing. The power of these lines are incredible. It rejected it. Look at how it rejected it here, 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 here. So in theory or in logic, what would we expect right here? Rejection. And that's what's happening. So short term, it hit its upside target. Not to say that over the mid to long term, it's not going higher. I actually do think eventually it will. But just common sense dictates you should get a pullback here of consolidation on silver, and that's what it's doing. I think gold right now. So silver's had its run just since May, basically early June. We've gone from about $32 and change to 39, and all while gold, and I'll flip over to my gold chart here, gold has just been consolidating, right? So a lot of sideways consolidation. I still think there's risk on gold for a pullback to about 3,050 or 3,000, but this again, this up move, this is your flagpole, your bull move. This inside parallel is a bullish pattern of consolidation. Even if it comes down here, I'd be buying gold on any pullbacks here for a longer move. And let's be fair, We all know what the government's doing. A new spending bill passed, going to add $3-4 trillion at minimum to the debt. We already are at 37 trillion. Just like Bitcoin longer term, I don't know how you don't like the idea of something other than fiat currencies as a store of value. I'm going to say 4,000. I do think we'll pull back close to 3,000, but if I have to say by year end, I think gold is closer to 4,000. I think instability. I think, again, eventually the economy will continue to weaken slowly, but it'll weaken. And I think that pushes more people into gold. Gold, I'm just waiting for the pullback to buy the miners. And you can see here this upsloping trend line. Notice we're starting to break down. That probably tells us we're going to be in for a little bit more weakness in the near term. But having said that, this trend line to this low, two low major pivots, I would start accumulating around $48 to $47 on the miners. I do think they go higher with gold. It's just a matter of short-term break point on a trend line here, which tells me the odds favor a move to the downside, and I'll just be waiting at the next support to be starting to accumulate them. This is a really interesting chart, David, because notice what's happening here. We were in this downtrend. You can see this high matching with these subsequent highs. We've now burst above that. So the dollar is starting to gain a little traction here. And also notice interest rates are also going up. So again, the question is, why are people rushing in to buy the US dollar? But also interest rates are going up as well. I mean, a little bit of an interesting action point here. But the point being is the dollar short term now, again, as long as it holds above this line, favors the upside. And again, that should be respected until proven otherwise. Upside target, I'll give you guys my upside target. See this last major low right here, kind of right in this same level. So I'd be looking for the dollar to get back to about 100 on the DXY. And then once we get in there, that'll be the first test of major resistance. But I think right now we're probably going back to 100 on the DXY.
Inflation rose again in June, moving further away from the Federal Reserve's 2% target and adding pressure on central bank policymakers ahead of their upcoming meeting later this month. The uptick in consumer prices comes as President Donald Trump continues to urge the Fed to cut interest rates, pushing for dramatic reductions of up to 300 basis points, a proposal most analysts see as highly unlikely under current conditions. Gareth Soloway believes inflation is likely to remain sticky around 3%. It's not extremely high, but still elevated enough to prevent the Fed from launching any aggressive rate-cutting cycle. A symbolic mercy cut by year-end might be on the table. Still, substantial reductions like those being pushed by the Trump administration are improbable unless there's a significant economic shock. Too much easing, Soloway argues, would risk re-accelerating inflation at a time when stability is still out of reach. Persistently high inflation has placed a significant financial strain on American households, particularly those with lower incomes. Families are paying significantly more for essentials like food, housing, and utilities, with little room to adjust their budgets. These pressures are especially acute for low-income earners, who allocate a larger share of their paychecks to necessities and have limited ability to save or absorb price increases. Federal Reserve Chair Jerome Powell recently acknowledged that the Fed likely would have cut rates earlier in 2025 were it not for the uncertainty triggered by President Trump's tariff policies. The central bank remains data-dependent, with policymakers closely monitoring key inflation and employment indicators as they assess whether and when to adjust policy. Let's get back to the interview.
I'm not sure if we're seeing the impact. Now, I do believe that tariffs do cause a certain amount of inflation. Whether it's transitory or not, we're going to find out. But in this report, we had the main CPI data for year over year coming in slightly hotter than expected. But if you remove food and energy, the core, it actually was better than expected. And so again, really the tariffs should be impacting everything, not just food and energy. And so I argue that maybe the impacts aren't quite yet being felt here. Now, I will say this is inflation is still relatively muted, even though it's upticking a little bit. And I do wonder if that gives Trump maybe a little bit more leniency to impose these tariffs that he's threatening. We know he likes to kick the can down the road, but he said, hey, Canada 35%, Mexico 30%, Europe 30%. And while everyone's expecting him to kind of back off on that and say, oh, we'll kick the can down again, I do wonder if the fact that the markets are at all-time highs and that we're not seeing more inflation, does that give him a runway to actually impose some of these? Maybe the market's not factoring that in. I do think that the tariffs will have an impact. I mean, especially in all fairness, it's not just tariffs, right? You have the the deportations going on. You have farms in this country that literally have no one to pick the crops, and they're going to have to pay a lot more to get Americans to come and pick those crops or automate it, which they're not at that point yet. So that again is inflationary on the food system. So it's just a matter of time, but I would argue that today's inflation report didn't really scream Trump's tariffs are having an impact yet. I think to some extent, this emboldens the Federal Reserve. Obviously, the Federal Reserve has sustained a ton of attacks from the administration. But I think Powell, in terms of wait and see, I mean, again, inflation upticking on the year over year, in line on the month over month, it just basically tells us to wait a little bit longer. And especially with the jobs data, I mean, listen, we're definitely seeing some weakness in the labor market, but it's in the underbelly, right? So, for instance, the last jobs report was solid. Even the revisions were not that bad, but the participation rate is starting to come down, which tells you people are dropping out of the workforce because they cannot find work. So yes, the jobs numbers are solid enough for the Fed to kind of sit on the sidelines at this point. What I would say is I would expect inflation to continue to creep higher, not just because of Trump's tariffs. There's other factors here. We talked about the deportations having an impact as well, but also I would just point out is that one of the biggest drivers about a year ago of inflation was the stock market, and the stock market was at all-time highs. We had the big correction in March into April. We're now back at all-time highs. So the wealth effect, people are feeling that again. They're feeling well. They look at their 401ks up 25% since April. That's a huge move. That makes people want to go out and spend on goods, for instance, new TVs, etc. And so I think that that can also play a role here. So I think a combination of all those things that I mentioned, you will see inflation continue to hold up. Again, I don't expect a massive spike unless new high tariffs of 30% go into play, but is it going to stay stubbornly around 3% inflation? I actually do think so, and that makes it very tough for the Federal Reserve to cut rates substantially. I think a mercy cut, absolutely. They'll do it by the end of the year, at least one, but we don't just want one, right? The markets are craving, 100 basis points. Heck, Trump wants 300 basis
Mm.
points. We're not going to be able to do that because it would then kickstart a higher inflation. The other thing I'll point out, I want to share my chart if that's okay with you.
Yeah, please.
This is a chart of the 10-year yield. This is concerning, folks. The 10-year yield, even after the somewhat muted inflation numbers, is now pushing up pretty substantially. We're nearing 4.5% again, and that's troublesome. Now, you do have resistance around 4.55, downsloping trend line. That should be a level where it's going to meet resistance. But if yields continue on the long end to push up, that makes borrowing costs higher and a lot of other factors. It also makes the distinguishing factor of investing in stocks versus bonds to be a harder one as you get a bigger yield on bonds over time here. I think the higher inflation trade would probably be to short the market overall. I mean, if you really believe that we're going to see over 3% inflation, what does it mean? It means the Fed, even if we go into a slowdown, it's more stagflationary, and the Fed can't lower rates as much, which again, the markets would react in a negative way to. So I think at these levels, that would be the play. Otherwise, you could buy the 10-year. If you think inflation is going to really develop, you could also potentially short the dollar overall. I start to get a little concerned, right? Because there's a divergence in essentially what is paid out on the U.S. debt. So 10, 20, 30 years, the bond yields are starting to go higher. The twos, lower, are going to go lower with the Fed. And remember, people, the Fed controls the short end. They don't control the long end. Who controls the long end? The market. So what I see is if the long end starts to go up further, let's say we get to 5% on the 10-year, that tells me that in parties like governments around the world that are used to buying the U.S. debt, they're demanding a higher interest rate. They don't believe in the financial structure of the U.S. like they did. The dominance of the U.S. dollar is at risk. De-dollarization is slowly, and I stress this because everyone freaks out that de-dollarization is something that's going to happen overnight. No, it's 10 or 20 years. But again, starting that process, it is starting, it looks like to me, as again, the foundational trust in the U.S. system with the U.S. debt is starting to erode. So these are all things that can drive the long bonds higher. The shorter end, usually, again, the Fed will control, and they will do their best to kind of control it for sure. Here's the S&P, right? And so number one, I've been doing a lot of charting. You can see these three trend lines. These three trend lines connecting major pivots here, major little pivot right there to this high, and then these lows. And these are all, notice how price right here came into the three trend lines, basically what we would call X marks the spot, where they all meet and it got rejected. And then look at how, yes, we've gone up, but then we pull back. And then we gapped up today, and the S&P is now negative on the day. And by the way, the S&P being negative in spite of Nvidia's news that they can now sell the AI chips to China, and Nvidia's up 5% today. So that, to me, when you start seeing good news and the stock market is not pushing up, not only is the technical lines right above current price, but now we're starting to see the fundamental positives not have as big an impact on the market. And that's, again, a signal that we could be ready to break down. I say ready because we could go sideways for another week or two. But one thing, I'll show you guys what I'm looking for. You want to know when the market starts to free fall a little bit? Take the low from April. So this is the April 7th low. Connect it to your lowest point here and drag it up. Look at that trend line right there. So if this line breaks, this is your uptrend line from April. So from the lows when the S&P was down about 20%, this is your uptrend line. If we violate and close below this, you'll see algorithms and institutional money start to most likely sell into any buyers of retail. And so really right now we haven't broken that yet. So markets are safe for now, but look, we're right on that line right now. So keep an eye on that level. On the S&P, that's right around 62.65. So 62.65, a close below that would be problematic.
Do you think Bitcoin leads stocks, or is it the other way around? Have you noticed a consistent pattern there?
Yeah, I mean, it used to be in 2017 and 2021 that it was a leader, meaning that Bitcoin would top out in 2021, for instance. It topped out in November. The S&P didn't top out for another 4 to 6 weeks, and we also saw that in previous cycles. This cycle, we just don't know because Bitcoin hasn't been around long enough with enough bull market tops to really be sure, but certainly historically it has led and been a signal of a top.
What we're seeing unfold isn't just a market move, it's a rebalancing of investor priorities in a world caught between inflation friction and geopolitical friction. As policymakers grapple with rising costs and trade tensions, silver is quietly breaking free from its long-standing constraints, finally confirming what technical analysts have long anticipated. Meanwhile, gold remains a monetary cornerstone, increasingly shaped by forces beyond traditional speculation: sovereign demand, fiscal overshoot, and monetary fatigue. As metals push toward uncharted territory, will persistent inflation and unpredictable policy decisions force a broader revaluation of what constitutes proper financial security? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.